Yes. So please come to IAS 27. This is a very simple standard. It deals with separate financial statement. Separate financial statement is a different concept. It is applicable only if the entity has either a subsidiary, associate, or joint venture. If a subsidiary, associate, or joint venture is not there, then the statement that is prepared is not called separate financial statement. Rather, it is called, either you can call standalone financial statement or you can call individual financial statement. If you have a subsidiary, associate, and joint venture, and you are not preparing consolidated financial statement, then the financial statement prepared is called separate financial statement. So in some countries, companies are required to prepare two sets of financial statement: separate financial statement also, as well as consolidated financial statement. In some countries, only consolidated financial statements are prepared, and separate financial statement may be prepared voluntarily due to some requirement. This standard does not make it mandatory that you will apply this standard, okay? But if you are preparing separate financial statement, either due to requirement of the law or due to any other reason, you will apply IAS 27. Okay? Have you understood the applicability? That means it is possible some entity may not apply the standard at all because the law does not require it to prepare, and there is no other reason to prepare this separate financial statement. But if you prepare separate financial statement, then you have to apply this standard. Very simple standard. Let us move ahead. An entity is normally required to prepare CFS of the group. Whenever an entity has subsidiary, associate, or joint venture. So world over, CFS is more or less mandatory now. The CFS gives you the performance of the entire group. It gives you the performance of subsidiary, associate, and joint venture at one place. We know exactly as a group how are you performing, how your resources have been utilized. Okay. But yes, some jurisdiction requires separate financial statement also. So financial reporting of such cases would be done based on the respective standards, like IAS 28 is used for associate and joint venture. IFRS 10 is used for consolidation of subsidiary. IFRS 11 is used for joint arrangement. And IFRS 12 is disclosure requirement of interest in subsidiary, associate, joint venture. So all disclosure requirement related to this consolidated entities is given in one separate standard called IFRS 12. Okay. Just like for financial instrument, there is a separate disclosure standard. Similarly, for all these group entities, there is a separate disclosure standard. However, when an entity chooses to prepare SFS, or when local regulation requires SFS, name one country where local regulation requires SFS. India. Okay. Then the requirement of the standard would be applied. I am not reading the definition of consolidated financial statement, that you know. So we'll come directly to our topic on hand. SFS, separate financial statement, are those presented by a parent. A parent means an investor with a control of a subsidiary, or an investor with joint control or significant influence over an investee. Are those prepared by parent or an investor, in which the investments are accounted for either at cost or in accordance with IFRS 9, that is financial instrument, or using the equity method as described in IAS 28, investment in associate and joint venture. This standard gives you three choices. The standard gives you how many choices? Three choices for accounting of investment in subsidiary, associate and joint venture in SFS. Either you follow cost method or you follow fair value method, and there is one more alternative given in separate financial statement. You can also follow what is called equity method. Equity method as described in IAS 28. Now what is equity method we will discuss in IAS 28, not discussed in this chapter, because there is a separate full-fledged standard IAS 28. Only for the time being, understand, in case of IAS 28, investment will be first recorded, okay, and then you will add or less share in post acquisition profit or loss of subsidiary, associate, joint venture. Normally subsidiary is not used, but associate and joint venture are used. However, in this standard one can apply equity method for subsidiary, associate and joint venture also. For your information, this is a difference between, in India there is a standard called Ind AS 28, which only says you can follow cost model or fair value model. But IAS has given you three options: cost or fair value or equity method. Equity method, if you want to follow, then you will have to apply the principles of IAS 28. In this chapter, we will not be discussing in detail equity method. We'll discuss that in detail under another standard. Separate financial statements are those presented in addition to consolidated financial statement. Financial statement in which equity method is applied for accounting for investment in associate or joint venture, then such financial statements are not called separate financial statement. Now there is a area of confusion here, because if you are applying IAS 28, there also we are applying equity method. In this method, as a policy choice, you may apply equity method. But if you are having an associate or joint venture, then you will be mandatorily required to follow equity method in those other standards. Then those standard will be called consolidated financial statement. But as a policy choice, for some investment in separate financial statement, you may choose equity method. Like for example, for associates, you may choose fair value method, and for JV in this standard, you can follow equity method. So then this standard will be called separate financial statement. But if you are applying equity method for all your associate, joint venture under IAS 28, so then that will be called a consolidated financial statement. You can selectively apply equity method under this standard for a given class of investment. Next paragraph. If an entity does not have subsidiary, associate or joint venture, then you cannot call your financial statement as SFS. Then you can call it by other name, but not as an SFS. SFS can be prepared only when the entity has subsidiary, associate or joint venture. Now see, in this diagram which you have to draw to keep you awake, financial statement individual or standalone, separate, consolidated. Individual or standalone is applicable if entity does not have subsidiary, associate or joint venture. If the entity does not have subsidiary, associate and joint venture. Then we'll come to separate. Separate financial statement is prepared by an investor where investment in subsidiary, associate and joint venture are accounted for at cost or in accordance with IFRS 9. One more line write down, or equity method. Or equity method, which is enough. This is just a small summary. Just to give you an overall view, when you call separate statement and when you call standalone statement. So when you have an option to account at cost, fair value or equity method, then it is separate financial statement. And consolidated financial statement of a group in which parent and its subsidiaries are presented as those of a single entity. Are presented as those of a single entity. Earlier, this equity method was not allowed in IAS 27. Only some amendment took place some years back, and now they have started allowing equity method also. But IND AS 27 says no. What we are talking in separate financial statement is the basis of measurement. And what IAS 27 is doing, it is introducing a method of accounting along with measurement basis. So Institute of Chartered Accountant of India says IFRS is wrong. We are right. Wow. Okay. Because you are mixing the two different concepts. Cost or fair value is a measurement basis. Equity method is a method of accounting, not a measurement basis. But they have allowed it. So you can't help it. But don't bother. Now come to next paragraph. An entity that is exempted in accordance with IFRS 10, which we'll discuss soon, which entities are exempt from requirement of consolidation. Investment entity, and there are some entities which fulfill some conditions, like it is a wholly owned subsidiary and parent does not require it to prepare subsidiary. It is neither listed nor in the process of getting listed, and its parent or ultimate parent present CFS which is available for public purpose. In short, that is exemption. Or investment entities. So an entity that is exempt in accordance with IFRS 10 from consolidation or exempt under IAS 28. Now, IAS 28 also gives you the same list of exemption. From applying the equity method, may present separate financial statement as its only financial statement. So, if you are exempted from CFS under IFRS 10 or from applying equity method under IAS 28, then what is the choice left? Separate financial statement. An investment entity. Now, this paragraph speaks about investment entity, that is, whose main business is investment, earning investment income and capital appreciation, and they basically manage the funds of other investors. They manage the funds of other investors for the purpose of earning investment income or capital appreciation that is required throughout the current period and all the comparative period presented to apply the exception to consolidation for all of its subsidiaries in accordance with IFRS 10, present separate financial statement as its only financial statement. Now, who are investment entities? These entities primarily business is to invest. Under IFRS 10, there is an exemption. What is that exemption? This investment entity need not apply consolidation, but they will have to measure the investment at fair value, and fair value through profit and loss account. So, an investment entity that is required throughout the current period and all previous period presented to apply the exception for all of its subsidiaries in accordance with IFRS 10 will present separate financial statement as its only financial statement. So they could have just combined the two sentences and one. All exempted entity will follow separate financial statement. Okay. Now we'll come to accounting in SFS. Accounting for investment in subsidiary, associate or joint venture in SFS would be either at cost or in accordance with IFRS 9, that is fair value. Under that also you have two choices: FVTPL, fair value through P&L account, or FVTOCI. And this standard also allows equity method as described in IAS 28. Now the note says the entity shall apply the same accounting for each category of investment. That means here, if suppose you have subsidiary and you decide to follow cost for one subsidiary, then for all subsidiaries will follow cost. Suppose you have associate, then you cannot follow cost for one associate and fair value for another associate. So if an entity has two associates, it cannot account investment in one associate at cost and other at fair value. And same thing for this equity method also. If an entity accounts for an investment in associate or joint venture in accordance with IFRS 9, that is fair value, as per the option given in IAS 28. In IAS 28, which we will see soon, normally they follow equity method, but there is an option, you can follow fair value. But if you opt fair value in IAS 28, you have to follow fair value in SFS also. If you opt for fair value in IAS 28, you have to follow fair value in IAS 27 also. But vice versa is not possible. In IAS 28, you can follow equity method, but in separate financial statement, you can follow one of the three. But in IAS 28, if you follow fair value method, then SFS also you have to follow fair value method. Okay.
For example, suppose one of the parent has only two associates.
One parent has two associates.
So now as per this, suppose I follow equity method for one of the associates, then I have to follow equity for second associate also.
Right.
Then it won't. So now it won't be considered
doesn't matter. You can still call it as an SFS.
That's what it is said, no? Earlier, that financial statement with equity method is applied for accounting for investment in associate or joint venture. Such financial statement are not SFS.
Then you have to check which standard you have adopted. So if you are doing the accounting as per IAS 28, it is better you call it that you have followed IAS 28 only. What is the harm? Only the nomenclature would change. Is it right? No,
But suppose I am in India.
you are in
Then
India.
I have to compulsory prepare SFS.
You have to compulsorily
Then
prepare.
I cannot follow equity method. I will have to follow fair value.
Under Ind AS, you have to follow that. Right now, the topic is IFRS.
Okay, not India, any other country where compulsory SFS is required.
Yes. So, journal entry now. How will you pass journal entry in SFS? Its nomenclature is little confusing here because you are following equity method under this standard. So, better you follow equity method under IAS 28 only. Na? So, investment account debit, when you buy the investment at cost, you will pass the entry to cash or bank to vendor if it is payable at a later date. This is cost, then IFRS 9 requires investment to be accounted at fair value always. Only in some exceptional cases for equity instrument when fair values are not available, then they allow you cost, and then cost is treated as fair value. Change in fair value will be recognized either through profit and loss or OCI. Now solve this question number 1. Try as homework. We'll check tomorrow. Question number 1 and 2 you will try as homework. Okay, will you try and come? Say yes. There's no enthusiasm in that yes. Yes.